Cryptocurrencies have already changed the world of finance and continue to grow, but how can you invest wisely without taking unnecessary risks? I'm not an expert, but I've been studying and want to share some strategies that can help you invest more safely. If you want to learn how to grow your wealth with cryptocurrencies, stay until the end of this video. What is investing in cryptocurrencies? The interest in digital currencies like Bitcoin, BTC, and Ethereum, ETH, has been growing rapidly. Trading cryptocurrencies has become an exciting and potentially profitable opportunity, attracting investors worldwide, including major financial institutions. The primary goal of cryptocurrency trading is to take advantage of price fluctuations. Traders buy when prices are low and sell when they are high, profiting from market volatility. If you're a beginner, the best way to start is by using a centralized exchange, as these platforms offer greater support and security. With time and experience, you can explore decentralized exchanges. To create an account on an exchange, the process usually involves providing an email and creating a password, accepting the terms of service. On some platforms, identity verification is required, which involves submitting official documents and proof of residence. Investing versus speculating versus day trading. Traditional investments, such as stocks, real estate funds, and bonds, are often compared to more speculative assets like cryptocurrencies and forex. The difference between investing and speculating lies in the time horizon and the level of risk involved. Day trading, for example, is a strategy that aims to profit from small price fluctuations throughout the day, requiring high experience and discipline. Long-term investors, on the other hand, typically have an asset accumulation plan, believing in the market's growth over the years. Why are cryptocurrencies so volatile? Volatility is one of the most striking characteristics of the cryptocurrency market. Prices can experience sharp changes due to several factors, such as institutional adoption or government regulations, macroeconomic events, such as financial crises and pandemics, market sentiment, and news related to blockchain technology. Due to their young and decentralized nature, digital assets tend to be highly sensitive to these factors, making price swings even more pronounced. Strategies for investing in cryptocurrencies. Welcome to the channel. Today, we'll explore some of the top cryptocurrency investment strategies to help you make more informed decisions. Before we begin, if you enjoy this type of content, make sure to like this video and subscribe to the channel for more investment and technology tips. Now, let's dive in. 1. Buy and hold. HODL, long-term investing. The term HODL originated in a funny way, as a typo of the word hold in a Bitcoin forum in 2013. This mistake went viral and now represents an investment strategy that involves holding cryptocurrencies for a long period, even during market crashes. This approach is popular because the cryptocurrency market is highly volatile. For example, in 2025, Bitcoin reached $102,378 but faced significant fluctuations. Investors who held onto their assets during past downturns were rewarded with later price increases. But remember, HODL works best for those who have patience and don't need their invested money in the short term. If you're enjoying these strategies, comment below which one you've used or plan to use. And of course, share this video with anyone who also wants to learn about investments. 2. Dollar cost averaging, DCA, investing in installments. DCA is a strategy where you invest fixed amounts regularly, regardless of the asset's price at the time. This way, you avoid investing everything at once at a market peak, and reduce the impact of volatility. For example, instead of investing $1,200 all at once, you can divide that amount into 12 installments of $100 over a year. This means you buy more when prices are low, and less when they are high. Advantages of DCA: reduces the impact of volatility, prevents impulsive purchases, helps maintain investment discipline. 3. Smart diversification. Investing in just one cryptocurrency can be risky. That's why many investors diversify their portfolios with different assets, such as Bitcoin, BTC, the most secure and established cryptocurrency. Ethereum, ETH, features smart contracts and a strong developer community. Stablecoins, to maintain liquidity and reduce risks. Crypto ETFs, to gain exposure to the sector with less volatility. Remember, diversification doesn't eliminate risks, but it helps balance gains and losses. The importance of reducing volatility risks. The volatility of cryptocurrencies is influenced by various factors, including government regulations, environmental concerns like Bitcoin's energy consumption, global economic crises, and unexpected financial news. These elements create sharp price fluctuations, making the crypto market particularly unpredictable. DCA is especially effective in 3 key situations. 1. In bear markets, where you end up buying more units at lower prices. 2. In volatile markets, where it smooths out the impact of price swings. 3. For beginners, due to its simplicity and lower psychological pressure. A practical example of a DCA investor in Bitcoin. Dollar cost averaging. DCA is a proven strategy for building long-term wealth, especially in volatile markets like cryptocurrencies. This simple approach allows investors to ignore short-term fluctuations while consistently accumulating assets. Staking and yield farming. Generating passive income with crypto. Yield farming, understanding returns and risks in DeFi. Yield farming has established itself as one of the most popular strategies in the decentralized finance (DeFi) ecosystem, allowing cryptocurrency holders to generate returns on their digital assets. This approach involves depositing cryptocurrencies into liquidity pools on DeFi platforms, where funds become available for loans, exchanges, or other decentralized financial operations. The basic mechanism consists of 3 main steps. First, investors allocate their assets to specific pools. Then, they start receiving rewards, which can come in different forms: interest on loans, transaction fees, or even new tokens distributed as incentives. Finally, the returns can be withdrawn or reinvested to maximize gains. This strategy offers significant advantages. Potential returns often far exceed those provided by traditional investments, with some pools offering triple-digit APYs. Moreover, it turns idle assets into active income sources, all within a truly decentralized financial environment, free from traditional intermediaries. How crypto staking works. Staking emerged as a crypto alternative to traditional fixed-income investments. Instead of earning interest in dollars, you receive rewards directly in cryptocurrencies by locking your tokens on a blockchain. But how exactly does it work? The basics of staking. When you stake, you are essentially lending your cryptocurrencies to help secure and operate a blockchain network. In return, you receive periodic rewards. Think of it as earning dividends for participating in the system. Important tip: start with small amounts, choose well-established platforms, and always understand the terms before locking your assets. Staking can be an excellent way to make your cryptocurrencies work for you, but it requires a cautious approach. Yield farming, risks and rewards. Yield farming offers impressive earning opportunities in the DeFi ecosystem, but also presents significant risks that every investor should be aware of before allocating funds. Main risks of yield farming. 1. High volatility. The cryptocurrency market is extremely volatile. Asset prices can experience sharp fluctuations within hours, directly impacting returns. If the value of deposited tokens drops drastically, the earnings may not be enough to cover capital losses. 2. Impermanent loss. One of the biggest risks when providing liquidity in DeFi pools occurs when the price of assets in the pool changes significantly compared to the deposit time. Even if prices recover, you may receive less than you initially invested. More common in pools with volatile asset pairs, for example, ETH, altcoins. 3. Scams and fraudsters. Rug pulls. The lack of regulation in DeFi makes it easy to create fraudulent projects. Rug pulls. Developers abandon the project and disappear with investors' funds. Fake dApps promise absurd APYs, e.g., 1,000% per year, to attract victims. How to protect yourself. Check smart contract audits, the team's reputation, and the project's history. Conclusion: is it worth it? Yield farming can be extremely profitable, but it requires caution. Works well for investors who understand the risks, those who research before allocating funds. People willing to monitor their investments. May not be ideal for beginners without technical knowledge, those seeking stability like traditional fixed income. Risk-averse investors. Final tip: start with well-established projects, such as Uniswap or Curve, and only invest what you can afford to lose. With the right strategy, yield farming can be a powerful tool in the crypto market. Diversification in the crypto market. In the cryptocurrency world, diversification is especially relevant due to the sector's high volatility. Although risks cannot be completely eliminated, a diversified approach can offer 1. Protection against sharp drops. Example: while Bitcoin might drop 20%, stablecoins maintain value, and some selected altcoins may rise. 2. Exposure to different technologies. From reserve currencies, BTC, to smart contract platforms, ETH, SOL, and utility tokens. 3. Learning opportunities. Investing in different projects helps understand various blockchain applications. Risk management. protecting your investments. Risk management is a fundamental pillar for any investor who wants to protect and grow wealth consistently, regardless of market conditions. Key risk management strategies. 1. Diversification. Spread investments across different asset classes, sectors, and regions to reduce exposure to specific risks. 2. Asset allocation. Define ideal proportions for each type of investment, based on risk profile and financial goals. 3. Hedging. Use financial instruments to protect against adverse market movements. 4. Dollar cost averaging. Invest fixed amounts at regular intervals to reduce the impact of volatility. 5. Stop loss orders. Set automatic exit points to limit losses during sharp declines. 6. Portfolio rebalancing. Periodically adjust allocations to maintain the original strategy. 7. Safe haven assets. Include traditionally stable investments during market turbulence. 8. Insurance products. Use instruments that protect against specific risks. 9. Professional advice. Consult experts for more informed decisions. Why risk management is essential. Helps navigate different market cycles. Maintains emotional discipline during volatility. Balances protection and growth. Adapts to different investor profiles. Final tip. Never invest more than you can afford to lose. The crypto market is fascinating but also unpredictable. Before allocating your capital, ask yourself, what amount could I lose without affecting my quality of life? What is my time horizon to recover potential losses? How would I emotionally react to a 20% or more drop in my portfolio? Example, while a drop in your bank account balance would have an immediate impact, a long-term investment, e.g., 10 years, can absorb daily fluctuations without compromising your final goal. Fundamental principles of risk management. Build a solid foundation. Maintain an emergency fund equivalent to 3-6 months of expenses. Secure protections like insurance before exposing yourself to market risks. Invest only capital you can afford to lose. Smart diversification. Spread your resources across different asset classes. Combine traditional and alternative investments. Include assets with varying behaviors in different economic scenarios. Beware of emotional traps. Avoid the sunk cost fallacy. Don't hold on to bad investments just because you've already put money into them. Resist overconfidence. Deeply understand each investment before committing your resources. Why plan your exit? Neutralizes emotional influence on investment decisions. Turns portfolio management into a systematic process. Significantly increases consistency in results. Protects against the risk of falling in love with investments. Effective exit strategies. 1. Program diversification. Strategically allocate capital across different asset classes, sectors, and financial instruments. When a segment reaches its appreciation target, rebalance toward areas with higher potential. 2. Position sizing management. Set clear percentage limits for each investment relative to the total portfolio. This automatically locks in profits when positions grow too much and limits exposure to problematic assets. 3. Derivative instruments for protection. Use put options or futures contracts as safety fuses. For example, buying puts protects long positions from sharp declines, acting as insurance. Remember, the best exit strategies are those tailored to your risk profile, time horizon, and financial objectives. What works for day trading may not suit long-term investments. Consistency and discipline in execution are just as important as the plan itself. Share this video with someone who needs to learn how to protect their investments. See you in the next content.